Hey everyone, welcome back to Corporate Decoder, the place where we break down companies' financial reports. And today we've got a new filing from Yext Incorporated, a company that helps businesses manage their online presence. This is their latest quarterly report, and it looks like there is a lot to unpack, especially concerning some big strategic moves they might be making and how that is reflected in their financials. Stick around to see what we uncover. If you appreciate getting straight insights from corporate documents, make sure you're subscribed and join our Discord community linked in the description below. So right off the bat, the company is dealing with a significant potential change. Management is discussing a proposal for their CEO Michael Walrath to acquire all the outstanding shares of Yext Incorporated. This is a big deal, and it clearly casts a shadow over everything else in the report. The board has formed a special committee to look into this, but for now it's just a proposal and there is no guarantee anything will happen. This uncertainty itself can affect business operations, and it is something we need to keep in mind as we go through their numbers. Let's dive into the core of the report, the financials. Looking at the balance sheet for the 31st of October, 2025, Yext has total assets of about $555 million. This is down from over $610 million at the start of the year, which might seem concerning, but it is important to see where that change came from. Liabilities are around $400 million. Leaving them with stockholders, equity of about $155 million. Their accounts receivable, which is money owed to them by customers, decreased significantly from over $112 million in January to about $62 million by October. This could mean they collected more money or that sales slowed down. We'll need to see how revenue panned out to get a clearer picture. Goodwill, which represents the premium paid for acquired companies, increased substantially from about $96 million to over $110 million. This is largely due to their acquisition of Hearsay and the more recent purchase of Places Scout, showing they are actively growing through acquisitions. Now let's talk about revenue. For the 3 months ending the 31st of October 2025, their revenue was about $112 million. This is a slight decrease from the same period last year when they brought in almost $114 million over the 9-month period ending the 31st of October 2025. Revenue increased to nearly $335 million compared to about $308 million last year. This growth is mostly thanks to the acquisition of Hearsay, which they finalized in August of last year. Without that acquisition, their revenue would have actually declined. This highlights that organic growth is a challenge for them right now, and they are relying heavily on acquisitions to boost their top line. The company mentions that revenue from subscription and support makes up about 94% of their total revenue, which is excellent for predictability. Cost of revenue increased by about 11% for the 3-month period and a significant 20% for the 9-month period. This means it costs them more to deliver their services. This is particularly noticeable in the 9-month period where cost of revenue grew much faster than revenue itself. This led to a drop in their gross profit margin from 77.2% last year to 74.8% this year. That decline in margin means a larger chunk of their revenue is being spent on direct costs, impacting profitability. Then we look at operating expenses. Sales and marketing expenses saw a big decrease of 22% for the quarter and 21% for the 9 months. They've cut back significantly here, likely due to cost-cutting measures and a reduction in headcount. Research and development expenses, however, increased by 7% for the quarter and a notable 20% for the 9 months, suggesting continued investment in product development despite cost reduction efforts elsewhere. General and administrative expenses took a massive hit, dropping 45% for both the 3 and 9-month periods. This is largely due to costs related to the Hearsay acquisition in the prior year that did not repeat. This reduction in GTIA is a major factor in their improved net income for the current year. As a result of these changes, they've moved from an operating loss of over $10 million in the quarter last year to an operating profit of nearly $8 million this year. For the 9-month period, they've turned a nearly $23.5 million operating loss into a profit of over $38 million. And the bottom line reflects this. For the 3 months ending the 31st of October, 2025 Yext reported a net income of over $6 million compared to a net loss of almost $13 million last year. For the 9-month period, they achieved a net income of over $33 million versus a net loss of over $20 million in the previous year. This is a dramatic turnaround and signifies a return to profitability, at least on a GAAP basis. However, it's always good to look at their non-GAAP measures. Their non-GAAP net income for the quarter came in at almost $17.5 million, an improvement from about $15.6 million last year. For the 9 months, non-GAAP net income reached over $50 million, a significant jump from about $28.7 million in the prior year. These adjusted numbers paint an even rosier picture of their operational performance, excluding one-off acquisition costs and other adjustments. And let's not forget adjusted EBITDA, a key metric for operational profitability. For the quarter, it was about $27.2 million, up from $23 million last year. For the 9-month period, it jumped to over $78 million from about $42.5 million last year. These numbers indicate a strong improvement in their core business operations. The company also provides revenue on a constant currency basis to account for fluctuations in foreign exchange rates. For the quarter, revenue on a constant currency basis was almost $11.7 million, showing a slight improvement from the prior year when adjusted. For the 9 months, it was about $332.5 million, indicating a more robust 8% growth on a constant currency basis compared to the Gaia app revenue growth of 9%, suggesting that currency headwinds did have a slight impact. Looking at cash flows, net cash provided by operating activities for the 9 months ending the 31st of October, 2025 was about $26.3 million, a solid increase from about $11.9 million last year. This shows they are generating more cash from their core business operations. Investing activities show that they used about $20.5 million for acquisitions and capital expenditures, a decrease from about $91 million last year, which was largely driven by the Hearsay acquisition. Financing activities for the 9 months were positive at over $10 million this year. This was primarily due to proceeds from a new credit agreement with BlackRock totaling $100 million, which they used to pay off their old credit facility with SVB. This new debt facility significantly strengthens their liquidity. Now back to that pending acquisition, the report explicitly lists risks related to this. They mention that uncertainty about this proposal may affect employee morale, customer relationships, and divert management focus. This is a very real risk that could impact everything from sales execution to innovation, if key people are distracted or if customers become hesitant to commit. Competition is also a huge concern. They face established players and new entrants in areas like enterprise search and AI-driven solutions. Their growth depends on integrating new companies like Hearsay and Places Scout smoothly, and if they fail to do that, their revenue could suffer. The company acknowledges that their revenue growth has slowed and even contracted in recent periods, with overall revenue growth being driven by acquisitions rather than organic sales. This is a significant point of concern. While they have turned profitable according to Gaia measures, the underlying organic growth picture is not as strong. They also mentioned potential difficulties in attracting and retaining sales personnel, something that has historically been a challenge. Despite recent profits, they still carry a substantial accumulated deficit of over $673 million. While they've reduced operating expenses, future increases in personnel, technology, and acquisitions could eat into profitability. The risk of not achieving or sustaining profitability in the future remains a key challenge. On the forward-looking side, Yext is diving headfirst into generative AI. This is a strategic bet that could pay off big time, but it also comes with significant compliance and reputational risks. The report goes into detail about potential issues with biased algorithms, unexpected results, and the reliance on third-party AI providers. Failure to navigate these risks successfully could lead to legal liabilities and damage their brand. Overall, while Yext Incorporated has made strides in improving its profitability and liquidity through cost management and strategic debt financing, the company faces considerable challenges. Organic revenue growth is lagging, and their reliance on acquisitions to drive top-line expansion is notable. The looming potential acquisition by their CEO adds another layer of uncertainty that could impact operations. Their heavy investment in AI presents both a significant opportunity and a substantial risk. From a Warren Buffett perspective, they are showing improved operational efficiency in managing their costs well, but the lack of consistent organic growth and the high dependence on acquisitions for revenue increase are areas that warrant careful watch by investors. The company's direction seems to be growth through consolidation and adapting to new technologies like AI, but the core business needs to show sustained organic momentum to truly cement its long-term health. Thank you so much for joining us today on Corporate Decoder. What are your thoughts on Yext's latest report and the potential acquisition? Let us know in the comments below. If you found this analysis valuable, please hit that like button and subscribe for more in-depth financial breakdowns. And as always, you can find more great discussions and support on our Discord community linked in the description. Thanks for watching, and see you in the next one.